This is Rod Kusin Spooman for Risk for September 25th, 2009. This is the second of two videos that we put out for today. The first video, part one, was dealing with the premium and how accurately the premium gave signals today. Introduce you to the subject of divergence. We're going to focus our attention primarily on the VIX, but we'll talk a little bit about the trend, the trend, and the trend of both of these indicators, and how we measure divergence using the Detrended Price Oscillator. Now, we mentioned at the beginning of the day that you had a new high on the premium at the low, which occurred at 8:41. That told you to go long. So based on nothing more than that, you went long right when the premium said go long. Now notice the trend here. We're watching the 1 minute VIX. This is a 1 minute VIX. The VIX is always in a trend. It's always in a trend. So the volatility that you saw take place up in here, there was never a time when the VIX had changed directions. There was some volatility in the Spoos, but by understanding the trend of the trend and the VIX, in this case particularly the VIX, you were able to anticipate that there was no good reason to exit a trade. Hold on to your seat when you saw that new low on the premium take place here. But the trend of the VIX was still long. VIX is going down, it works inverse to the Spoos. We have a DPO on the VIX being charted here. The way we read divergence, as stated on our website, RSKsys.com, look at the section on divergence. The primary method that we use is to look for a type 1 divergence. And a type 1 divergence says we've got to have a new high on the Spoos, a new low on the VIX, and divergent on the DPO in order to take a short trade. Now these funny little dots on the screen, you can't see them real well because if we expand this too much the resolution goes down. But these are telling us where we're hitting potentially new lows on the VIX, and when certain things happen that have to do with calculations we make, we change the colors around even more. Okay, in any event, you hit a new high on the Spoos here, another new high ultimately right in here, and we measure the price of the DPO here, which was 23, and then here, which was negative 22. Pardon me, it was negative 23. So the VIX is hitting a new low, but the DPO is hitting a higher low. That's divergent. And when divergence on the VIX takes place, we frequently see right at that moment, using this definition for divergence, we see a trend change. Now you were expecting that if you had read the premium, because you had a new low on the premium, an unsatisfied new low on the premium right here. So you already knew the Spoos were coming back to 42.25, and if we're going to do that, this market has to short. The simple divergence formula told you exactly when to do that. And even if you hadn't, okay, when the Spoos attempted another move to the high right in here, the trend was itself divergent, a type 3 divergence. So the trend was telling you, get out of this, go short. Now you short the trade, you know that you're going to come back down at least to 42.25. But now watch this. As this new trend on the VIX was taking place, look at the DPO. Now the DPO, theoretically, if we're hitting new lows on the Spoos, we should be hitting new highs on the VIX and new highs on the DPO. But look what happens. Okay, you hit new lows in here and ultimately over here and then finally over here. Now look at the price difference here, 36.25 here, 36.25 there. Look at the VIX. The VIX hits a new high here. $26.34, $26.29. Now let's notice. The first time the VIX hits this, it is at a new high, but the DPO is hugely, hugely divergent. If that wasn't enough to tell you to go and get out of the short trade, you probably would have needed a baseball bat, because somebody was in need of knocking some sense into your head. This was obviously going to turn. And if that type 1 divergence wasn't enough, you got a type 3 divergence the second time that price was tagged, 36.25. And now the VIX itself is divergent. Everything told you to get out of that trade right there and then, particularly because of this major divergence on the DPO. So there was enough information to have made some excellent trades during the day. Now the fact remains that if we went back to our group reversal system, we actually got out of the first trade with about 6 points, got into the second long trade with another 6 points, and by shorting it, just simply using divergence, you were able to get out of this trade at about 48 and held it all the way down to 36. It's another 12 points on one trade. That's what you can get. That's what you can expect from the group reversal system by properly reading the premium, by understanding divergence. If you put all this together, you can't help but pull off what our motto is always telling you: never have a losing day. This is Rod Kusin and Spooman for Risk.